Well, last Friday saw a huge drop in the markets, and I want to share with you today the one indicator that told me that that was potentially coming. And also, I want to share with you 5 stocks that I'm avoiding this coming week of June 8th because they're actually starting to set up very much like the top of Robinhood, Palantir, SoFi did. And we all know how that ended. So I do not want my capital tied up in a stock that's going backwards. So I'll share with you those 5 that I'm avoiding. And then also there's 4 that actually still look quite good. I'm going to share those with you as well. First things first, this is of course not financial advice. It's simply what I'm doing and have done based on my own individual goals and risk profile. Don't copy random strangers on the internet. Do your own research, make your own decisions, and get really good at managing your own money. With that said, let's dive on into the charts and see exactly what we're looking at here. So what I was looking at all of last week that told me that a decline was probably inevitable is quite simply the Stochastic RSI. It's my favorite indicator. If you've been around, you'll know that I use this to time my entries and exits. And what I saw last week was that on the chart of SPY, the price had made a higher high, but the Stochastic RSI failed to get that high as well. This is known as divergence. Bearish divergence is when the price is making a series of higher highs, but the Stochastic RSI, or even just your standard RSI, is failing to do so. That tells us that momentum is leaving. So when we started having these sideways days and we weren't gaining in the Stochastic RSI, to me, that was a case of, I think this pullback that we've been waiting so long for is finally upon us. And then, of course, Friday was exactly that. So what am I waiting for now? Just the Stochastic RSI to come back down, then to start turning back up. Where might we get? Well, probably at least to the 50 EMA. If we can get to the 50 EMA, that would be a very healthy correction that we've needed, and then we can potentially start the next leg up. Now, let's have a look at stocks that I'm not trading this week or anytime in the foreseeable future because they're just not setting up well. In fact, they're looking very much like Robinhood did. And I want to show you exactly what we're looking at so that when you're in the charts with me, you can see what I am looking for. When we got to the top of Robinhood, we made a high and we failed to make a higher high. That was the first signal that caused all of this, right? If we come and look at SoFi, much the same. We made these highs, then we made a lower high, then we had this drop. Palantir. We made this high, we made a lower high, then we had this drop. Okay, so for me, I am always actually realistically, that was SoFi's lower high even, right? So I am always on the lookout for this setup. If I see that a stock is failing to make higher highs, that's my signal of, you know what, let's not trade this right now because there's always a stock that is still making a series of higher highs. So what am I avoiding this week? Number 1, Bloom Energy, BE. Now, BE, we made the high, we made a lower high here. I actually still have an open position. So when stocks start doing this and I'm in a sold put, so I've got a sold put, I had it at 240. So last Friday, I rolled that back down to 220 for an extra credit. And now I'm just looking to manage myself out of this position, right? My anticipation is that we will get a bounce here at some point. I have no intention of holding this until expiry. I'm just looking to take some of my profit, close that position in case we come tumbling back down. The next one, VRT. Now, VRT failed to make higher highs throughout last week. I actually had an open position from back here. I closed it out on, can't remember, either Tuesday or Wednesday for 50% profit, noting that we were struggling to move up. This is on my do not trade list now, right? I got out of that trade. I wasn't waiting for expiry. I wasn't going to say, you know what, I've got a relatively safe strike. None of that. Why? Because if we do come all the way back down, potentially to these, $200 levels where we gapped up, I don't want to own stock this high. I would rather take my small profit and continue to move on to better trades. GLW. I have traded GLW so much over the last years. I'm not trading it right now. Why? We failed to make a higher high. Quite simply, this is on my we're not trading at the moment list in case we continue to make this move down. And Amazon already had its breakdown. Can you see that here? Higher high, lower high, breakdown, right? If you had a cash secured put up here at, 260, then you're kind of stuck in it right now. And our favorite, Nvidia. High, lower high, bang. Okay. So I'm not selling cash secured puts on any of these stocks until we can take out these highs convincingly, right? So I'm waiting for these to come back into play. What am I looking at that still actually looks quite okay instead? TSM still looks quite okay, right? High, higher high. So as long as we can remain and bounce above around this sort of 50 EMA, which is in line with this previous high, as long as we can bounce it around this level, then we still remain in a nice bullish momentum, right? When would I be looking for an entry? Not just on a red day. I don't just sell on the downwards days because down usually means more down and more down and more down. Instead, I'm waiting for a bottom to look like it's forming. Maybe a few sideways days along this moving average. But ultimately as well, I'm looking for the stochastic RSI to make its way back down and then turn up. Why? Because usually once the stochastic RSI has come all the way down, at least the bulk of the declining move has been. So that's how I look to time my entries on a cash secured put. What else do I like? Coherent. High, higher high. We're still doing the same thing. So again, if we can bounce off of either this moving average that we're on at the moment, the 20, or even if we come down to the 50, as long as we can get a bounce here, then we're potentially still in, again, this same bullish momentum. So I'm happy with a cash secured put at these levels if we bounce, right? So if we get to these levels, we bounce, I would be looking at taking a position then, not beforehand. I don't want to guess where the bottom is. I like to just wait. Credo, another one of my favorites. I've traded this forever and a day as well. Also, we still made another high, right? So a pullback, totally fine, totally normal. If we get around these levels, even down to this EMA, I'm actually still in a position on Credo. My strike is at 185. If it looks like this might be breached, I'll roll it down and out, right? But again, I'm just looking for what moving average or what support level are we going to get support at. We'll see when we get this turn of the stochastic, and then we'll start the move up. But right now, Credo is still looking quite okay. And then the last one, Nebius. Same story, right? And until we make a lower high, I'm happy to have this in my list of stocks that I trade. So at the moment, I actually do have a cash secured put here at the 195, I think it actually is that I've got, 195 level, right? If we bounce from here, great. If we keep continuing the move down, then again, potentially I'll just look to roll that out a little. Again, I'm looking for, if I was entering a new position, I would want the stochastic RSI just to make its move down, start to turn back up. But at the moment, until we make lower highs, I'm happy at this level. I will manage that position. And ideally, we still continue this cycle of higher highs, higher lows. I don't make it too difficult for myself, right? The one thing that I follow more than ever, and only because I got caught out in the past, right? It's the only way that I've learned these lessons, is watch the chart. If we make lower highs, stop trading it. There are so many good stocks to sell options on. I don't want to be assigned, because assignment always equals either money out of rotation or waiting to be recovered, or selling call options but at very small premium, because if I'm assigned here, chances are the stock is probably trading around here, and I've got a vast number of strike prices between where we're trading and where my assignment was, so I can't get great premium, right? So if you're looking to sell puts this week, that would be my playbook, what I'm avoiding, what I'm looking at, and what I'm waiting for. We don't have to go in all guns a-blazing on Monday. We can wait for this downward movement to happen. Patience is the name of the game, right? I know seeing high premiums gets so tempting, but waiting an extra day or two really doesn't change the amount of capital or the amount of premium that you get. What it does, though, is change the amount of capital that you need for your trades, because if we continue to move down, we can move our strike price down, right? So we don't have to have $19,000 in the trade. We might be able to have $16,000 in the trade. There's always another trade to place, as long as we're patient, as long as we live to place the next trade. So I hope you found this helpful with what I'm watching this week. Make sure, if you haven't followed, that you follow along. In the description, there is a link to my upcoming 50K club, where I trade $50,000 over and over and over and over again in a month in order to generate as much income as possible, as safely as possible, by doing things like this: avoiding stocks that might be turning bearish, staying on stocks that are bullish, because ultimately we want to follow the momentum. So if you're interested in that, the waitlist link is in the description. Pop your name on it, and as soon as that's up and running, I will let you know. So that's it for today. Have a beautiful week trading, and I hope you get some really good premiums this week.